Traders, do you know what inducement really is? Inducements are specific market setups designed to tempt traders into entering positions, often in the wrong direction, so smart money can collect liquidity. In simple terms, an inducement is a trap that leads traders to enter the market in the wrong direction before the real move begins. Because smart money needs liquidity, they often induce traders into early breakouts, fake reversals, or misleading pullbacks. Traders may see order blocks that look clean, but are not the real ones, FVG fills that appear to be valid entries, or equal highs and lows that look tradable. Then price suddenly reverses, sweeps their stops, and moves in the intended direction. Understanding inducement is important because it helps you avoid entering too early at fake levels or liquidity traps. Instead, you learn to wait for the real point of interest, which can significantly improve your win rate. To understand why inducement appears in the market, we first need to understand how liquidity works. Imagine that large financial institutions, often referred to as smart money, are interested in purchasing a currency pair. To execute these large positions, they require a significant number of sellers and corresponding sell orders in the market. Without available sellers, no transactions can take place. Because of this, smart money often needs to trigger the stop-loss orders already present in the market in order to execute their buy or sell positions. This is why the market sometimes creates movements that make traders believe they clearly understand what price is doing. This situation can create an illusion for retail traders, making them believe they are trading on the correct side of the market. However, instead of continuing in that direction, price often moves toward their stop-loss levels. After triggering those stops, the market then resumes its intended direction. That is why identifying liquidity on the chart is essential for traders who want to understand how price truly moves. And this is exactly where the concept of inducement comes into play. At its core, inducement means creating liquidity before the real move. It is the final liquidity created to fuel the true move, and it can appear in different forms: structural inducement, liquidity-based inducement, and time-based inducement. Let's begin with structural inducement. Among all types, structural inducement is the most important because it appears directly inside market structure and forms patterns that traders see every day. Structural inducement occurs when price creates a false structure shift, such as a fake CHOCH or a misleading BOS, which encourages traders to enter early or in the wrong direction. In this example, price is trending higher and continues printing bullish breaks of structure to the upside. However, when we focus on the most recent break of structure, it initially appears completely valid. Price breaks and closes above the swing high. Naturally, this leads traders to expect buy setups at the demand zone or order block that cause that break. Then the outcome becomes clear. You enter the buy, and price quickly takes you out. This is exactly how structural inducement traps the majority of traders. The reason becomes clearer when we look deeper. This so-called BOS was never a real break in the first place. The entire move was driven by resting buy orders sitting below, inside the discount zone of the main bullish leg. If you draw your Fibonacci tool from the swing high down to the swing low, you will notice that price did not even retrace into the 38.2% level, let alone the 50% level of the previous impulse. This is critical. For us at ComLucro, a retracement that does not reach at least the 38.2% level cannot be considered a valid retracement. And even when price retraces only to the 38.2% level, these very shallow pullbacks tend to create inducement and liquidity hunts rather than clean entries. Because of that, traders must be cautious with shallow retracements. The ideal scenario in a bullish trend is to wait for price to retrace into the 50% level or deeper, where price enters the discount zone. This is where real institutional buying is more likely to occur, and where you avoid becoming liquidity for inducement moves. Understanding this helps you avoid fake structure breaks, recognize liquidity-driven pullbacks, and stay aligned with the real direction of the market. Now, let's move on to the second type of inducement. Liquidity-based inducement is the most common form of inducement you will see in the market. It occurs when price intentionally creates a new high, a new low, or a small order block or breaker that looks very clean, with the purpose of attracting traders, collecting their liquidity, and then delivering the real move. And this happens every single day across all markets and time frames. The main objective behind this behavior is to generate stop losses that smart money can use as fuel. By pulling retail traders to the wrong side of the market, their stops can be collected right before the true move begins. That is why you often see a small high form before price drops, a small low form before price rallies, a fake breakout before a reversal, or equal highs and lows getting swept by just a few pips. These are not coincidences. This is smart money deliberately engineering liquidity. To understand this behavior even more clearly, we need to look at where liquidity actually sits on the chart. This brings us to the concept of static liquidity. Static liquidity refers to specific zones in the market where a large pool of orders is resting, such as stop losses, buy stops, and sell stops. When a trader gets stopped out of a position, the market absorbs the orders associated with that stop loss. Recognizing a liquidity sweep before price reaches our point of interest is therefore very important. These sweeps often confirm the strength of a supply or demand area, and many traders use them as a confirmation factor. The idea is simple. The market requires liquidity in order to generate momentum. If price does not sweep liquidity before reaching a key level, that level often becomes the liquidity needed to fuel the next move. Static liquidity can appear in several common areas on the chart, such as below equal lows and above equal highs, above swing highs and below swing lows, around trend lines and channels, and inside order blocks. It can also form around support and resistance levels, Fibonacci retracement levels, and near important candle bodies or wicks. Because these zones are widely recognized by traders, they tend to attract large numbers of stop losses and pending orders. For this reason, price often moves toward them to absorb liquidity before continuing its real move. Now you might wonder why price often forms an inducement right before tapping into a fair value gap. The reason is simple. If price moves directly into an FVG without inducement first, there is no liquidity. Smart money has no fuel to reverse the market. The reaction from the FVG becomes weak, and the entire setup can fail due to a lack of sellers to buy from. In simple terms, inducement is what creates the liquidity that fuels the move out of the fair value gap. So trader, please remember that the ComLucro channel is focused on giving traders clarity, confidence, and structure. And this Smart Money Concept series is designed to do exactly that. Each video breaks down one ICT concept in a clear and practical way, helping you understand how price behaves, where liquidity forms, and how market structure develops. If this explanation helped you see the market with more clarity, make sure to check the full Smart Money Concepts playlist linked on the card and in the description, where all these ideas are organized step by step into a complete learning path.